you invest in stocks, you need to know how to read a cash flow statement. In the previous video, we learnt what the cash flow statement is and why it's important. We also learnt that there are three sections to the cash flow statement: operating activities, investing activities, and financing activities. In this video, we will dive into operating activities. Operating activities are the cash inflows and outflows of a business that are related to its regular business operations. Basically, it's the cash generated from selling goods and services and the cash spent in order to deliver those goods and services. The goal of the operating activities section is to calculate the cash from or used in operating activities, also known as operating cash flow. As we discussed in my previous video, there are two methods to account for operating activities: the direct method and the indirect method. The indirect method is more commonly used because it can be built using the income statement and balance sheet. In this video, I'll focus on the indirect method. The indirect method starts with net income or loss, which is pulled straight from the income statement. Because the income statement uses an accrual method of accounting and the cash flow statement uses the cash method of accounting, we need to make some adjustments. We add back cash inflows, which are not included in the income statement, and subtract non-cash outflows, which are included on the income statement. Essentially, the income statement records revenue and expenses which may not have occurred this year. Let's say you sell a shipment of shoes this year, but are not paid for them until next year. The income statement will record this as revenue, but because the cash hasn't changed hands yet, it needs to be subtracted from net income on the cash flow statement. It's the same for expenses. Non-cash expenses are expenses which are recorded on the income statement, but where no cash actually changed hands. An example would be depreciation. Depreciation is just a method for expensing an asset over time. Say you buy a car today for $10,000 in cash. The income statement doesn't record this $10,000 expense all in one go. Instead, it is depreciated over time. Say the car has an expected life of 10 years. The car can be depreciated by $1,000 every year for 10 years. Every year for 10 years, you would record an expense of $1,000 on your income statement. That $1,000 expense is included in the calculation for net income, but we don't want net income, we want operating cash flow. That $1,000 in depreciation isn't an actual cash expense. $1,000 doesn't leave your bank account every year to pay for the depreciation of the car. It's just an accounting expense, and so it is added back on the cash flow statement. It might be easy to look at a real example. Let's look at Nike's cash flow statement. Here we have the operating activities, or cash provided/used by operations. Step 1 starts with net income. Step 2. Adjust to reconcile net income or net cash provided or used by operations. Nike had a $703 million depreciation expense in 2023. This is an expense included on the income statement, but it's not a cash expense, so we add it back to the net income on the cash flow statement. Next, we have deferred income. These are taxes that have been paid but are not due yet. Because they aren't due yet, they aren't included on the income statement, but because they have been paid, it means cash left the business, so we subtract it from net income. Next, we have stock-based compensation. Stock-based compensation is when employees are paid in stock instead of cash. This is included as an expense on the income statement, but because it's not a cash expense, we add it back to net income. Next, we have amortization, impairment, and other. Again, these are not cash expenses, so we add back $156 million to net income. Finally, we have another non-cash item, net foreign currency adjustments, which subtracted $203 million from net income. Step 3. Adjust for changes in certain working capital components, other assets, and liabilities. Technically, working capital is the difference between current assets and current liabilities. But we don't include items that aren't used in the operation of the business, such as cash, investments, and debt. What you are left with are the operating current assets and operating current liabilities, things such as accounts receivable, inventories, prepaid expenses, accounts payable, and accrued liabilities. These are all items you'll find on the balance sheet. There's a lot of items here, so I'll briefly explain the key ones. When the business's current assets increase, it means they have spent cash to buy them. Take inventory, for example. If the value of your inventory goes from $1,000 to $2,000, it means you have spent an extra $1,000 in cash to buy inventory. In 2023, Nike had an increase in inventory of $133 million. This means an extra $133 million in cash was spent to buy inventory, so we subtract it from net income. When a business's current assets decrease, it means less cash is owed to the company. Take accounts receivable as an example. Accounts receivable is money that customers owe you for goods and services you have delivered them. If accounts receivable has decreased, it means your customers must have paid you. Nike had a decrease in accounts receivable of $489 million in 2023, so it is added back to net income. Next, we have a bunch of items. Let's just call these other assets. In 2023, Nike had an increase of $644 million in other assets. If assets increase, we have spent more cash, so we subtract this from net income. Lastly, we have another set of items we can just call other liabilities. In 2023, Nike had a decrease of $225 million in other liabilities. If liabilities decrease, it means you must have paid them off, so cash must have left the business. The key thing to remember about changes in working capital is that when current assets increase, cash decreases. When current assets decrease, cash increases. If current assets increase, I must have spent cash to pay for them. If current assets decrease, I must have received cash for them. When current liabilities increase, cash increases. When current liabilities decrease, cash decreases. If current liabilities increase, I haven't paid cash for them yet, so my cash must have increased. If current liabilities decrease, I must have spent cash to pay for them. If we sum up all the items, we get the cash provided or used by operations. This is also called operating cash flow. If the number is positive, it means the company generated cash from operations. If the number is negative, it means the company lost cash from operations. When I invest in stocks, I want the company to be generating cash from its operations. Cash from operations is one of the most important numbers you can find on the financial statements. Why? Operating cash flow is used to calculate free cash flow, and free cash flow is the best measure of profitability to value a company. To calculate free cash flow, you get operating cash flow and subtract capital expenditure, also known as additions to property, plant and equipment. But we will cover capital expenditure in the next video, where we discuss investing activities. So if you are interested in that, hit the subscribe button so you are notified when it's out. Let's summarize. Operating activities are the cash inflows and outflows of a business that are related to the regular business operations. There are two methods to calculate cash from operating activities, the direct method and the indirect method. The indirect method is far more common. The indirect method has 3 steps. Step 1, start with net income. Step 2, add back cash items or subtract non-cash items which are used to calculate net income. Step 3, adjust for changes in net working capital. When cash is added back, it will be a positive number. When cash is subtracted, it will be a negative number. If you add up all the items, you get the cash from or used in operating activities, also known as operating cash flow. Operating cash flow is a key component of free cash flow, which is used when valuing companies. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.